Cherif, tell us about your business and what's limiting growth right now.
So my business, really, you can divide it into two things. I have an educational part where I help people learn about commercial real estate, invest in real estate, set up their own real estate funds, do even joint venture agreements with me, set up asset protection. These are all things that I do under the education company. It's been up and running for 26 years now.
Oh, wow.
And the other part is my own real estate investments and real estate funds, etc. And I have a large portfolio of historic properties, mixed-use commercial buildings in Old San Juan, Puerto Rico. I have a great team. So this is really my business, is educating in real estate, doing real estate deals, doing sometimes with students, doing by myself, and continuing to grow with the structure of the teams and all that.
What's limiting growth right now?
In the educational business, of course, marketing. If I can market myself better, I'll get more people coming in to do deals with me, to set up their own real estate funds and create a bigger network. So marketing is always a challenge because I'm not the best at all these marketing, digital marketing stuff. But I have a great vice president, Ashley Jones. She does an amazing job with that. When it comes to my real estate investing, actually, I have it down to a science right now. I've been in it so long that I have a great team. The challenge is always when you lose a good team member, to replace that person, train them, make sure they fit the position, the company goals, and the rest of the team. Those are the three elements I look for always. They fit the position, they fit the company goals, and they fit the rest of the team, so everybody supports everyone.
Right. Okay. So let's do a deep dive on the education business first. So you mentioned you do commercial real estate, you do funds, you do JVs, and you've been doing it for 26 years. If you had to draw a pie chart, how
Yes.
would you split the pieces of like where the biggest revenue is coming from?
Okay, that's a very good way to put it. Biggest revenue comes from real estate funds. I set up people on how to set up, instead of a syndication where they can raise capital for just one asset, I show them how to raise capital for a real estate fund. So they set up a structure where they can put an apartment building, land, tax liens, tax deeds, mortgage loans, all in one structure, like a mutual fund, instead of buying one stock. So they actually, instead of raise money for one apartment building or storage facility, they raise capital constantly for their real estate fund. So they need only one real estate fund set up for life. And they can take assets, they can sell assets, and the investors invest in it for a debt structure, meaning the investors invest and get 6%, 8%, or even more. It depends on the type of investor, how much money they put in, etc. It's a great structure. It's very profitable because, I mean, for an attorney to set up something like this will cost at least $50,000 because it's very unique and very powerful. We do it for $25,000, including a full day of training with me. Now, I'll do the live training with the individuals that come to my place in Puerto Rico or in Los Angeles because I love to hear about how they invest, what they do. I want them to understand the SEC rule, the Security and Exchange Commission. And as I teach them, I can see who will fit with another person. I can help them do some partnerships together. So it opened a great network. That's the biggest part in the pie chart in terms of revenue. The other part is the joint venture, which is I train people on how to find vacant single tenant buildings, like an old Jack in the Box that's sitting vacant, an old Subway sitting vacant, standalone with a drive-through. Basically, those are the best. And I show them how to identify the ideal property, how to use my proof of funds. I have millions sitting in my own fund and cash and stuff, so they can actually be taken seriously with the brokers to put it under contract. And usually when the property is vacant, instead of selling at $1 million or $1.2 million, it sells usually, let's say, $700,000 because it's not bringing any income. So we put them under contract, very good prices. Then I train my people to, actually the students and all this, to talk to national tenants. There's a whole list of national tenants they can talk to, and they can get any of the national tenants that want to lease, like QSR, quick service restaurants. They lease for 10 to 15 years. So as soon as they express interest, we get on a conference call, like a Zoom call, and we negotiate. We're going to give you tenant improvement, give you $100,000 to fix the place the way you like. We'll sign with you. These are the prices, and we'll give you a couple months free rent. And once we get them to commit and sign, the property value goes from like $600,000-$700,000 to $1.2 million, $1.3 million. And then I share that upside gain with the people that are doing the joint venture with me. They found the deal. They called on the tenants. So I give them 10% of the upside all the way to 25%. If we get the tenants to sign 15 years, which is happening quite often, they get like on a 400,000 upside, they get 100,000. And if the tenant signs just, let's say just they sign for a 10-year lease with a corporate guarantee and triple net, we just give them 10% of the upside. So they make 40,000. So it's been very successful. We've done it for a good 8 years now. Maybe this is the 9th year. I have over 1,000 video success stories. I have moved a lot of money this way. It helped me grow. It helped people start in the commercial real estate business. It's not as profitable as the funds, but guess what? When people do the first deal, second deal, they do it for themselves. Like the first deal, they assign to me. Second deal, they buy the property for themselves. They get the loan, and then when they place the tenant, the property goes through a high increase in value. Then they realize, oh my God, I can set up a real estate fund. Then they come to us and they set up the funds and they grow their business model. The third part of the pie for the training company, the education company, is we set up people with asset protection. We have a very unique asset protection program. I devised it like maybe 11 years ago, and it's been one of the best creations I've ever done, which basically, when people have a home and a couple investment properties and a business, they're really scared. They have loans. So they're scared somebody sues them if they hit somebody like with their car. They get scared that an attorney of the plaintiff sues them beyond the insurance coverage of $1 million or $2 million. They can sue, let's say, $3 million. So they say, we're going to take from your insurance $2 million, which is your insurance coverage, but we're going to go after your assets and we're going to win the case because you were negligent. They will prove whatever. You hit the guy and he was a dentist and now he can no longer function as a dentist. He could have made $3 million in his lifetime, etc. So what they go after is the actual equity in whatever you have. So what we do is we set up a Wyoming LLC, and instead of funding it with actual cash, we fund it with an IOU. Like I will put the money later and we record that IOU against the properties. This is one of the only 3 liens that can be federally approved in the United States, because one lien that's approved in the United States is when you get a loan from the government, from the bank. So it goes through escrow and they record the mortgage lien. The second lien is a mechanics lien. You build a pool, you fight with the contractor. I'm not going to pay you the balance of $13,000 or $20,000. He can record a lien. The third type of lien approved federally that is enforced is if you and I go into a partnership, you put cash, and I say, Abi, I don't have the cash, but I owe you 100. You say, well, Cherif, I need it secured on something. So I put IOU in the partnership we have in the LLC, and I record it against the house. That's a third type of lien. So I use that credit structure in the United States that makes the banks and anybody that has a lien so protected to use it to our advantage. Because when we set up the Wyoming LLC, we set it up as a separate entity with 13 business trees and flowing through to a living trust that goes to the family and the loved ones. So it becomes extremely powerful because it's truly following the system of the United States. And we checked it federally, and I have attorneys that sell it for us. It's not profitable at all. It's actually almost a break even for us. But it's a great way to get to know people. And then these people set up, protect themselves, and they love it. Then they go in and get the joint venture program, or they get into the real estate funds, or they actually become investors in the funds, So that's the pie.
Right.
Biggest profitable, setting up the funds, which is beneficial for them. Joint venture real estate, single tenant buildings to start in commercial. And the third one is to protect any assets they have.
This is so much stuff to deep dive on. But before we do, just to give viewers context, how big are these ventures? Like, how big is the company? Like, how many people, and what's like a 3-year revenue target that you have set for yourself?
So I have 3 people only that are in-house. So there is Ashley Jones, the VP, and she has under her 2 people that have been with me many years. They do like follow up and some sales calls, clarifying questions to people. So that's the team in-house. We have a company outside overseas that actually does the marketing for us on a regular basis. And instead of looking for content, a lot of my content is actually what I'm doing. Like it's like I document what I do. So here I am in front of this building. We're looking at this, that. And then I'm doing an event. I get invited to speak. So they film me, they post things. So it's mostly content of documenting what I'm doing.
Right.
And we do about a little less than 2 million a year. I don't grow wide with my education company. I grow deep. Like we got a person, show them how to get into commercial. They make money, then they want to do their own deals. They want to then set up their own fund. So that person just becomes. I've had students with me over 20 years, believe it or not.
Hmm.
I have a lot of success stories where people say, I'm making money, or I set up this and it was amazingly unique, or I just finished this training and now I understand how I'm going to run my fund. Now, what's the goal for 3 years? Like you said, I would like to be at 6 million a year in gross sales. But then again, I don't make the goal, like my goal is to be enjoying what I do always. And
Hmm.
that's the priority for me. I like to have fun with things. Even if I'm going to have a lawsuit, I'd like to have fun with it and not stress about it. I know it sounds a little crazy, but
Hmm.
I'm a guy that approaches life and business like it's a game. And the
Yeah.
essence of the game is you're creative, you're playful, so you're never inside any of the problems because life is full of problems. So I
Right.
always, when there's a problem, I come out and I look at it like if it's somebody else's problem, a good friend of mine, how will I advise them? And then I
Hmm.
become my own best advisor. So it becomes a little bit of a game. I remember
Hmm.
a few years ago, I had a lawsuit and I sued somebody who countersued me. So it got really ugly. But I knew I was right. So I said, okay, we're going to play. I hired the best law firm. I told them how to reduce their taxes through a very esoteric structure of taxes in the United States with involving US territory of Puerto Rico. So they charged me a lot less when they were a very high, like it's the biggest, literally the biggest attorneys firm in California. Their books are taught in the legal schools in the universities of state of California, like the evidence books, etc. So I hired them and told them, relax, don't worry, we're gonna do it this way. I worked with them, and it was a lot of fun to learn how they think and how they prepare the discovery and the deposition. And I said, look, whether I win or lose, I know I'm doing the right thing. And at the end of the day, we won. We won big, like we won triple what I had sued for, and we devastated the other party. But my whole approach about it was, I'm not going to stress about it. Of course, there were moments where like, oh my God, they need the backup of this, they need the evidence of that. Can find go through boxes and stuff. But at the end, it's like you're playing a game. It's like, oh, we're losing the score. We gotta serve better the volleyball, or we gotta score a goal right now.
Hmm.
And then at the end, it was a big win, and it made me better with my asset protection program and understanding everything a lot better. So
Hmm.
that's the priority goal for me, is to keep enjoying what I do. The minute I'll stress out, like my fund, my real estate fund, we kept it at 100 million. And every time we went over, we just sold assets and reduced it because I didn't want to become a slave to working so hard and having like I hear people bragging about we have $1 billion in assets under management. I'm thinking, how do they sleep at night? Maybe because even if you have a big team, you still have to monitor the team, you know.
Right. Right.
And I just want to enjoy life a little bit, travel and relax, and
Yeah.
so that's the
We
goal. But six
we
million is the goal.
yeah, we got the numbers, and on the real estate investment side, just quick numbers. Current revenue and 3-year goal.
So we're making 6 million in revenue per year in the passive, really real estate income,
Hmm.
and I don't have a goal to increase it, believe it or not, because it's steady income. This is a portfolio that I've been owning it since 2003 when we started buying, 2004, and it's been every like the first early years we bought so much in Puerto Rico. This is actually on the website. People can see it. CREPR.com. Commercial Real
Hmm.
Estate Puerto Rico.com. CREPR.com. They would see all the mixed use, beautiful commercial buildings where the cruise ships arrive in Old San Juan. I have big tenants downstairs, residential Airbnb upstairs. It's a cash flowing portfolio. All I want is just I half of it or more than half of it is free and clear. The rest I am paying down. So I would say within 5 years I would have it all paid off,
Hmm.
including selling maybe 3 properties specifically I want to sell because they're at that maximum income. They're not going to make me more. So I'm just going to sell them. So that's the goal, is free and clear and have credit lines in the tens of millions to be able
Hmm.
to jump on opportunities to
Right.
keep. Yeah. And that was very challenging. I mean, we said, oh, it sounds so good. Oh, he's got like so many buildings, but it was challenging. Many people didn't want to sell. We had issues with the construction, rehabbing and stuff because you have to follow what's called the historic integrity of the buildings. But we survived all this and prospered. And when the hurricane hit, there was a hurricane in 2017. I said, "Oh my gosh, what have I done?" You know, you have like that moment of doubt about life. And then 3 weeks, nobody could go to the island. Then I arrived, and I actually have a video on YouTube, and it's called Old San Juan after Hurricane Maria. And I have my little camera, GoPro camera. I'm filming from Cristo Street, Fortaleza Street, Tanca Street to where the cruise ships are. Everything is closed. There is water on the ground. And I'm saying, as you see, Old San Juan did not get affected. You should come back as soon as the business comes back and stuff. And then it hit me. This is water on the ground. This is not blood. You know how Warren Buffett says when there is blood
Yeah.
on the ground, as long as it's not your blood, continue investing. I ended up buying 7 buildings just within a
Mm,
year after the hurricane. So
mm,
sometimes what you think is bad, if you reframe it in your mind, you find this is the best opportunity and you can make things happen, you know.
mm, mm. Um, thanks for explaining all that. I mean, there's a lot of things I wanted to deep dive on, but let's start with the you mentioned let's talk about the funds, right? You
Mm-hmm.
mentioned it is a debt structure. So my understanding, and please help
Mm-hmm.
educate me. So my
Yes.
understanding of a debt structure is normally you will get a fund when you want to say invest in an apartment building, and you want to raise capital. So that's like an equity based fund where you have equity as part of the fund, and then you collect capital from various investors, and then you do distributions as the rents come in, right? And my
Yes.
understanding of a debt based fund is where essentially we're giving money to other investors, right, to do their real estate deals, and then
Mm.
we're collecting interest, and then we're giving out the distributions from the interest to our investors. Is that my correct understanding?
What you're describing is a mortgage fund, but a debt fund is the one that is not an equity fund. Meaning, let's just say, let's use a comparison of somebody who has a syndication,
Hmm.
which is an equity syndication, and me, or let's say I set you up with a debt fund. So the person with an equity syndication, he or she tells the investors, give me so much money. I'm going to put it as down payment. We're going to buy this apartment building. We're going to do this and that for it. So I need to raise a little bit more money to rehab some units and do this and that. From the cash flow, we're going to pay you so much. And then within 5 years, we're going to sell it for more. And from the upside, we're going to give you 70 or 80% of the profit. And we're going to keep 20% on that sale because we added the value to the building. When we
Hmm.
raise the money, we're going to charge you 3% on the purchase. That's called an acquisition fee. So we're going to charge the investor an acquisition fee, a management fee, and a disposition fee. But they have to sell within 5 years. They have to pay from the cash flow. And if problems happen, hey, problem happened, like all what happened to people last few years with the apartment building, and say, hey, sorry, we lost the money, and tough. So that's an equity structure. The debt fund, and that's the only thing that can put in a syndication, one apartment building, one asset. In a debt fund, you're now, let's say you're set up, you can tell the investors, we're going to buy this apartment building, we're also buying this land, we also have this note that cash flows, we're also selling this property, carrying the financing. So you have so many things in one structure, and you
Hmm.
can raise money. And usually I'll give you the structure from 25,000 to 249,000. Investors can come in at that level, 25,000 to 249. They receive 6% per year. And we do the payout twice a year, February 28th, August 31st. Now, a lot of people have IRA money that they're sitting in maybe CDs and whatever, making 3%. Imagine all of a sudden they make 6%, so double the money, and it's steady income that they can rely on. They can even reinvest the money. Anyone investing 250,000, they will go to Class A shares then, and they will get 250,000 and up. They'll get 8% per year. That's 4% on February 28th, 4% on August 31st. Our debt fund, the way I have it, I have approval with the SEC that an individual, let's say I'm setting you up, Abi, I will give you also Class C shares, which is something called at the discretion of the fund manager, whereby you can tell somebody, I can give you 10%. You're not Class A at 8%. You're not Class B at 6%. I'm going to give you 10% because you're going to give me $1 million. And now, with that type of structure, you're taking the money, you know what the payments you're going to make, and you go and you can get properties. Let's say you do hard money lending with that money. Let's say you buy a building and you improve the cash flow, and you're getting, let's say, 12%, but you're paying 6 and 8 and 10. So you have a spread on the money, but you're under no obligation to sell that building. It's not like a syndication where 5 years later you must sell. You can keep the building that improves, you can refinance and cash out all the investors. As long as they got paid just like you promised them, you can cash them out at any time with the accrued interest. So what ends up happening is you can build a legacy for your family through a fund structure where investors are happy to receive payment that can actually be compounded if they want, or they can do all this, and you charge them no fees for acquisition, no management fees, and no disposition fees. You're just paying them a fixed return steady for them. You know, 8% a year. Many investors elect to reinvest their money to compound it. So every 6 months, they get 4. They say, don't pay me, just compound it. 4% every 6 months reinvested in 10 years, that's 8% a year, becomes 12% annual rate of return. I'm not talking IRR, internal rate of return, which is very misleading, and syndications. Very hard to calculate that, because internal rate of return has to do with how long you held the property, what the taxes are. Here, we're holding assets to become a legacy for the family. It's completely different. I set people free. They buy the assets, they improve them, and 5 years, 6 years later, they can actually refinance, cash out the money, and buy another property. They still have the same investors. And so in a syndication, if you refinance, by law, it's an equity fund, the syndication, you have to pay down the investor's money proportionately. You can't take it to invest something else. So it's completely different. We charge no acquisition fee, no management fee, no disposition fee. And we tell the investors, if you want to cash out anytime, give me a notice by email, I'll cash you out within 12 months. Why? Because there are 5 ways to cash out investors. Number 1, you can borrow against the property. Number 2, you can refinance the property. Number 3, you can sell one of the properties. Number 4, you can put your own money in the fund to cash out somebody. And number 5, you can get new money from a new investor and pay out the other person out that want it out. In a syndication, equity syndication, that will be a Ponzi scheme. In a debt fund, that's like a refi, because you have the assets already. You're literally taking new money from Susie to cash out John, who wanted out, with the accrued interest. It's extremely, extremely powerful, gives the investors flexibility, steady, reliable income. They can compound their returns. They invest more money. So completely. So I do the training for people. I have even done some trainings with attorneys to tell them how to set up this, because maybe out of 50 funds, you'll find one debt fund, because people don't even set up funds. They set up syndications. Because if you go to a lawyer and say, should I set up a syndication or a real estate fund? The lawyer is going to say, set up a syndication. Why? Because they make money each time you come, 25,000, 15,000, 20,000, whatever, Some of them charge 35,000 for one syndication. Go buy the apartment building. Or you're doing well, you want to raise money again? Let me set up another syndication for you. It's 30,000. I set up the whole thing for 25,000 plus one full day of training on how to present and all this. And no attorney will do training because there is liability for them. But the attorneys are in-house with us, and that's how we do it. I have a very good structure for that.
Right. Tell me about how, say it's a brand new investor comes to you, right? I'm guessing so you have your own fund, and you
Yes.
also train other people on how to create their own funds as well, right?
Yes. I
Two
have my
aspects.
own fund, but I set them up with their own fund. Yes.
Right. So tell me about the journey. Is this what is the ideal customer profile, ICP, or in your case, ideal student who comes
Yes.
to you? Are you targeting people, or are you hoping people at least have some kind of audience already, like some kind of investors lined up? Or this is
Excellent.
like a brand new person who's just starting out, but they want to get into the capital raising game. So tell me about
Okay.
that.
Very good to know the profile customer you're looking for, because that's how you can talk their language and help them go to the next level. The person that's totally new, like somebody that's just have a home and want to get into the world of real estate investing, they should come into the joint venture agreement. I train them how to find an empty building, single tenant. I train them how to use my proof of fund, what to tell the broker, how to put a deal, under contract, how to send me the email. They communicate with me directly to do the first deal and assign it. Then the light goes on. They can do bigger deals. For the real estate fund, the profile client is somebody who has a strategy that made them money, whether wholesaling residential, buying and fixing residential, or doing some commercial, or they used to do syndication. They have a strategy that made them money, and they run out of money. Because in real estate, you're doing well. Boom, 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 3-4 deals. I don't have any more money. I gotta go dig some money. So then they start doing these family partnerships and talking to friends and stuff. That's not gonna get you too far. The way to do it is then to come and say, Cherif, I'm ready to set up a real estate fund, because this way I can keep the assets, I can help others get cash flow. I have the watchful eyes of the SEC to show everybody that I'm compliant, I'm not playing games. So train me on how to handle this and be in compliance, and how do I raise the capital, and what assets should I then grow with, because this is my strategy. So I understand what they're doing, what assets they do, and I show them how the structure is all encompassing. So one structure for life. They don't need to set up each year or each deal. They can buy and sell and buy and refinance. They can even do 1031 exchange inside for their own fund to bigger deals, because it helps the investors. They can grow exponentially, and their work becomes with residual income and compounding returns. And that's when, believe me, in 3 years, I can take somebody who's going to work 13, 14 years, and it's compressed in 3 years because the fund structure is right.
So let's play out with an example. Say
Sure.
we have a fix and flip, single family houses. They
Yes.
have, say, currently 3 houses in their portfolio, and they want to expand to 30. That's the
Yes.
goal, right?
Yes.
So they are out of capital, everything is deployed, they have rents coming in, right? So they have passive income coming in. They don't have any more friends and family who want to invest. So now they come to Cherif, and they're like, all right, so you tell them, all right, so this is how we'll structure the fund. And
Yes.
and the person is like, yeah, that makes sense. But they still have to go out and raise the capital, right?
Yes.
So
Yes.
how because the person, if I'm coming to you, I'm spending $25,000 for you to help me set up the fund and educate me on the compliance and the SEC rules and how I should be marketing it. But then I still have to market myself. So what is the next step? Like, how do I market and find new investors to
Excellent.
get money?
So we take that person, say, okay, we have 3 homes cash flowing for you, and you can scale this to 27 more homes, so you can have 30 homes, or even 30, right, just under the fund. So we set up a private placement memorandum. I have a first call with them on Zoom to understand what they do. And then I discuss what's called the 5 Ps. Who are the people that will be involved if we set you up in a fund? What kind of projects you're going to do? So it's going to be residential expansion, and it's going to be him and her, and
Yeah.
her as like the wife, maybe mortgage broker, whatever, or by themselves. Number 3, what's your positioning? What will make people attracted to you? What's your unique selling business model? Oh, you take these homes from the auction, and then you have an in-house team that rehabs and make them so nice, converting the 3-bedroom, 1-bathroom to a 4-bedroom, 2-bathroom that's needed. Okay, so that's your positioning. Then the performance, which is, what is the story with the money? When you get the money, how are you going to tell people what you're going to do with their money? Oh, I'm going to buy the property at the auction. We bring it immediately in less than 60 days. We have it rehabbed and looking good, advertised, and line up a tenant. Okay, so now what's the story with the money? It's the performance. And number 5, what's the profit? Profit meaning now you're going to raise 25,000 minimum, which will be Class B shares. You pay people 6% per year, pay out 3% twice a year, like February 28th, August 31st. Those who give you 250,000 and more, you're going to pay them 8%, February 28th, August 31st, 4%, 4%. And those who give you that money can cash out, ask their money out at 12 months notice, etc. But if they commit longer and they give you more money, you can put them in Class C shares and pay them more. And you can get loans, and you can do this. Okay, so now we have the people, the projects, the positioning, the performance, and the profit. So now I discuss that with them on the Zoom call. I tell them, okay, next call is going to be with the attorney. like today, I have a call in 2 hours with an attorney and a couple that actually used to do syndication. They said, "Oh my God, we've been paying so much money." So the call with the attorney today with them is going to be me telling the attorney that works with us, okay, they're going to be a debt fund. It's going to be an all-encompassing fund. They're going to do all types of residential, all type of commercials. Even though that person has residential right now, I know that in the near future, as they scale to 30 homes, they're going to be like, oh my gosh, I'm raising so much money. I want to go buy an apartment building with 50 units already. I want to go
Mm.
do storage facilities, etc. So we do an all-encompassing structure. We do the debt fund structure for the fixed payouts. We do
Mm.
all the disclosures for the risk that people will have, and we set them up with what I call the Reg D 506C. The Reg D
Mm.
506C is a regulation that is pre-approved by the Securities and Exchange Commission to publicly solicit. So a person can go on social media and say, we're looking at this building and we're going to do this and that. And what happens, that becomes their marketing piece and their legal piece. The private placement memorandum will have all what they do, an executive summary of how they're going to pay the investors, all the disclosures of what can go wrong, and the conflict of interest because if in case they want to grow personally. And one of the best things I actually invite people to do is I tell them, so you invested in those 3 homes. You put, let's say, 100,000 in each home and it's cash flowing. So you have 300,000 of your money and you run out of money. We can have these homes pledged into the fund. Like literally, I show them, I have agreements when we set up the fund for them. I'm gonna cash out your 300,000. We're gonna put these homes and the income right into the fund. Now you cashed out 300, you can reinvest your own money and cash yourself out again into the fund, and then take your
Mm.
300 out. The investors' money will come in, and yet they will get so much. So their 300 can become 3 million in no time. So that's
Mm.
when, after the private placement is ready, we meet face to face in my home or in my office, whether in California or in Puerto Rico. I have an office in Florida too, but actually everybody likes to come to Puerto Rico because they can see my buildings, take it too. But then I sit with them and I tell them, this is how you present it. This is how you do your social media. Let's now tell you exactly, here are some set of PowerPoints to put your information and video yourself, and I will critique your video. And then when you meet people in a party, when you go to an investment club, you can tell people, listen, I got a 14-minute video here that tells you about who are the people involved, the projects we do, our positioning, the performance of what how we handle the money, and how we do the payouts. Let me send it to you. But then you can only raise money from accredited investors, those who have a
Mm.
net worth of $1 million excluding the home, or 200,000 in income last 2 years, expecting the same this year, or if they're a couple, 300,000 last 2 years and expect this year. So it becomes such a unique structure. And guess what? It is the only structure that the SEC allows you to have open with no date of closing. It's a
Mm.
debt fund and 2 ways to close it. Investor asks you to come out. I told you they give it 12 months notice. You cash them out. You get another
Mm.
investor in. Or you decide, you know what? I want to cash out 5 of these investors. You cash them out. Oh, I want to shut down the fund, but you keep the LLC of the fund and have it flow through to your living trust for your kids, your loved ones, etc.
Mm.
That's what's so powerful about this structure. It is totally unique. It's totally next level.
Couple of clarifying questions. So you mentioned,
Mhm.
we're like essentially doing cash flow properties. So the question is like, would it ever make sense to, like, for example, we buy land and some
Uh-huh.
of like our like investors that we deal with, they like to
Mhm.
do like long subdivision plays. Like they would
Yes.
buy like say a 200-acre property and then they'll subdivide into like 10-acre parcels, and then they
Beautiful.
will like, and then they will maybe put in some roads and then sell it. But this whole project takes like 2 to 3 years, right? So
Awesome. Awesome.
there is no cash flow coming in for like until we start selling individual parcels. So
Yes.
will this fund structure work there? Because I'm guessing the investors coming in, they're expecting the cash flow to start right away.
What a great question. I love your question because you're not just a podcaster, you're an investor, you raise capital, you understand the whole thing. So here's how it's done. Remember, I said we have class A shares paying 8%, class B shares paying 6% for people that start like 25,000. Class C is at the discretion of the fund manager. So let's say I'm setting you up with a fund. I'm going to say, Abi, let's just go ahead and do this. You're going to attract people and you're going to tell these people, we have all these assets, we do this and that, and we have this project that's going to take 3 years. So those coming in it, I'm not going to do any payouts for you. We're going to give you Class C shares. So you will be coming into the fund for Class C shares, whereby I'm going to write on your promissory note there will be no payouts for, let's say, 48 months to give yourself an extra year of cushion. No payouts for 48 months, but for your delay, I'm going to give you 10% per year. It's not going to compound, but it's going to be 10, 10, 10, 10. So now somebody gives you, and you say, and you have to put in a minimum of, let's say, 500,000. So let's say you get 5 people, it's 2.5 million, and they're so happy because they're going to get 10%, 10%, 10%. They're going to get 40%. But you only offer that when you know that maybe in 3 years you're going to make 50%, because you're really doing the big heavy lifting and the big money is in these developments. Actually, I have several developers that set up my debt fund. They buy the land cash, they get a construction loan, so they don't even need to borrow that much. But whoever comes in with them is happy of not paying anything. The lender gives them the loans, and if they have to borrow a little bit more to make the payments, that's one thing. Some lenders say we're going to accrue all this, and on the payout we can give you an extended loan. So it becomes a beautiful structure where the developer himself could go make 20, 30, 40% on the money. I have some people that make 100% on these, but they're so experienced in developments, it's crazy. So really, they pay the investors amazing returns. Investors say, it's my IRA money anyway, I don't need the cash flow. So I'm willing to wait for the 10% per year or 9% per year, whatever you offer that makes sense for them. They're part of a big project, but they're not counting on cash flow now. They're counting on a big cash out. And actually, believe it or not, we've done that. And we tell people 4 years later or 3 years later, hey, listen, your million is now $1.3 million because it's 3 years. Do you want to cash it out now, or you want to leave it in the fund? If you leave it in the fund, it's be at 8%, and we can do the cash outs every 6 months. You'll be amazed how many people say, I don't want it out. What will I do with it? Now it's $1.3 million invested. Beautiful. Let me get a payout every 6 months. So then we pay them the 8%. So it'd be 4 and 4, and they stay. So to answer your question, we structure, that's the hybrid fund structure that nobody has, and not many attorneys like to do it. I mean, we set up the fund for people at $100 million per person. We give them a website. It becomes their marketing piece with the link to the SEC. So if anybody says, Abi, do you really have a fund for 100 million? Where is it? You click on the link, it goes to sec.gov, to the government site, and it says your name, it has your LLC, it says that it's a Reg D 506C, that you have the right to raise up to 100 million, that you can leverage it with loans of 200 more million, so it could be a $300 million fund. And let's say you're doing so well, you want to grow to $1 billion, God bless. Then we can modify it and say you're going to, have up to $1 billion in assets. I found that 100 million is plenty to have a great life, plenty of room, plenty of stuff to pass on. And with the debt fund, you are truly building a legacy, not just working hard to give the investors 80%. This guy was doing a presentation. He gives the investor 80%. And then when he can't pay them, he say, hey, it's an equity fund. We took the risk. We failed. The interest went up. Come on. Big difference.
You mentioned hybrid funds. Attorneys usually don't like to do it. Why is that?
Well, they're not too familiar with it. The attorneys always want the simple template syndication. I'm not taking a cheap shot at attorneys, and some attorneys are great. But my attorney does not only the structure, he does litigation as well. Now, when you go to an attorney, ask him, do you do just the syndication setup? Guess what? 9 out of 10 will tell you, we don't do any litigation. We just do the structure. Why? Because it's a template. Whip out the template for 30, 35,000 and don't do any training. Come on.
The other question I had was, so you mentioned these Class A, Class B, Class C shares and the interest rates attached to it. Is this like a recommendation? Like if I wanted to pay more, I wanted to do Class B at 7%.
That's I give people a frame of work like, Abi, this will work, but do you want something different? For example, I suggest the cash out with a 12 months notice. I have some people that said, let me put 18 months. I'm going to cash them out probably in 8, 9 months, but I want 18 months notice to cash them out. If you tell me, yeah, Cherif, I can pay people 7 and 9 is going to look more attractive. Wonderful. Today, this morning, I was talking to this guy. He had me on his on like some what they call round table Zoom, whatever, and everybody was talking about what they do. Well, we finished it. Then he texted me, "I want to talk to you privately." And I talked to him. He said, "I can pay people 10 and 12. I'm making
Mm,
so much with these projects, but I can't raise enough money. I understand what I'm doing wrong. I've been paying 80% of the profit to investors. If I'm going to keep 100% for every 5 deals I've been doing, I could do one with your structure and make the same money." I said, "Okay,
mm,
we'll set you up." But he said he's making so much because he has a joint venture with somebody that finds the land, they do the development, they take stuff that's already making cash flow and they add to it. So,
mm,
like apartment buildings with huge lots. Everybody has a business model that works. Gotta look into real estate funds. And I'm gonna tell you this:
mm,
people listening to this sooner or later will realize, oh my God, I should have done a real estate fund. Some will listen and understand how it can work for them, and some it will take them years to figure it out.
mm. I have a
So
question on the maintain. You mentioned you charge 25K upfront and then they don't have to pay anything else, right?
that's it. It's a flat fee. This way, we can make any modification, any changes when we set up the fund. Once it's set up and running, if they want to make a change or something, let's say a year down the road, they want to add something or they raise so much money they want to, then they can deal directly with the attorney and then they pay a small hourly fee. But
Mm,
usually we set it so airtight. We've been doing it for years now, and I'm very low key about it. I don't go like I should actually go more like to big events and start promoting this. But I have so much time to do other things right now that most of the work since COVID time has been on the online. It's amazing. I used to do my
mm.
own live events. I don't know how I spent so much time doing all this while I was doing the investing. It was crazy.
Yeah. What about like the SEC compliance obligations? I'm sure you have to file something every year, right? So
Yeah,
who
every
does that and why
the
is this?
attorney. The attorney does. It's a very small fee because there are some fees. Like I give you an example. Let's say we set you up. Abby, what state are you in?
I'm in Nevada.
So Nevada. So let's say we file your real estate fund in Nevada. And so when we file with the SEC in Nevada, there is a federal SEC and there is a state SEC. So when we file it there, you can go get investors in Nevada. But let's say a friend of yours calls you and say, "Oh my God, Abby, I didn't know you have this fund. I want to send you 250,000." You will send him the private placement memorandum, the PPM. He's going to fill out a qualification questionnaire. I qualify because I'm accredited. I make so much. They're going to fill out subscription agreement. I subscribe for 10 shares at 250,000, and they're going to send you the documents. You're going to send them a promissory note as soon as the money is received. Money is received, you send them promissory note, and then you have to contact the attorney and say, "I have a new investor from the state of Arizona." So now
Hmm.
what happens is he now files the same fund. The Reg D is filed in the state of Arizona because every state, the SEC wants to know, do we have any residents here investing, and they're investing with whom and where is that person? So they're going to be like, let's say it's called Abi Capital Fund. And we set you up, by the way, we also give you the website. We set you because we know it's too complicated for a regular company to set up a website that's in compliance with the SEC. So to stay in compliance with all the SEC in the United States, any investors from any state, we file it there. The other thing is I train people on what to say, what not to say. Like there are a bunch of questions that come up when you finish a presentation in an investment club or in a group meeting. And how do you answer that with absolute integrity and total compliance? Just give you an example. You can say, "We guarantee you, da 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 da."
Hmm.
We can say that word. We can say, "This is no risk." Now, obviously, a real estate fund with many assets is a lower risk, much lower risk than investing all the money in one asset in a syndication. That's why in a syndication, they have to always try to beat each other. "We're going to pay you 12%, 13% IRR. Why? Because it's high risk. And a real estate fund is a lot lower risk.
Hmm.
So you can explain to people how, but you can say it's totally secure. It's no, I'm giving you examples, but there is
Right.
a way to present to follow an investor's mind because people, you're talking to the voice inside their head and you want to be clear, you want to be transparent. This is not buyers beware, this is full transparency. And let me say, who shouldn't come and set up a fund like this? A person
Hmm.
that likes to exaggerate, a person that's a bit insecure, that have, let's say, already 7 million in assets, but they say, I have 10 million in assets. Just, is
Mm.
7 million small? Just say 7 million. The guy's like, I want to say that I have 10 million. You already have 7 million. Why don't you tell the truth? You will be much more comfortable. And then they realize, okay. And I always tell them, what if the SEC comes and audit you? And you said you took a company public. Which company? When? I didn't really, because I sold it to this guy, then he took it. Okay, then let's say the truth. So I
Mm.
weeded out, like sometimes we tell people, we can't take you because you're out there, you're a cowboy, man. You're not
Yeah.
following the rules. So
Yeah. So just to go back to the original question, what are the maintenance fees and ongoing fees they can expect? I know it's a low amount, but
no,
what
no,
what can people
yeah.
expect?
So expect to have a bookkeeper. So every 6 months when you do the payout, you got to have a bookkeeper that does the, okay, you took John and Susie and Fred and Philip, etc. And we actually have, when we train people, we give them an Excel sheet that can literally give it to the bookkeeper, plug in the names, this 6% or 8% or a class C. So they have to pay the bookkeeper every 6 months. And at the end of the year, at the beginning of the year, the 1099. So that's a fee for a bookkeeper. There is no other fees to maintain the fund, other maybe yearly to refile it because it's an ongoing fund. It's an open-ended fund, so there is a fee to renew it. It's around like $500 or something per year. You don't need to have audited financials. It's the type of fund that really is the least expensive, and you're under no obligation to keep raising money. You can set up the fund and say, I'm going to wait 90 days to see what's out there and then start raising money based on certain things. Some people set up the fund and they have assets, and what we do is we give them an agreement between the fund and their assets so they can take some of the income of their assets, put it into the fund. So I show them how to do that. We have conflict of interest disclosures so they can get their money out and go get another building and then assign it to the fund. So it's not a costly proposition like Reg A plus, which is very expensive to maintain. You have to do quarterly disclosures. You have to do filing with the SEC constantly. You register with the SEC. You have to do audited financial. That just costs you like maybe 40,000 a year to maintain over there. Our
Mm.
structure that I'm telling you, it is the most flexible, the most powerful, bar none.
Right.
Mhm.
What kind of objections do you get? Like when you say you already st- uh, built the fund out, it's all structured. Now you're raising capital, right? You
Yes,
are, obviously your recommended interest rate 6%, 8%, 10%. You
yes,
go out there. What are the common objections people can expect? Because I'm sure some people will be like, well, I can just put it in S&P 500 and it grows,
exactly.
right? Stuff like that.
So the first objection, let's address the elephant in the room. Abi, you seem like a good guy, but I don't trust you. And why
Hmm.
wouldn't they trust you? The key thing is they didn't understand exactly how the process works. So just the credibility factor has to be clarified. Look, this website is directly transparent to what the Securities and Exchange Commission, sec.gov, shows that I filed with them. If I want to play games, I wouldn't go to a government organization that controlled the raising capital and deployment activities in the United States. So right there, boom. When somebody's pitching, to avoid any trust issues, I am filed with the SEC. Here is the sec.gov. It shows my name, my entity, and I'm filed with them. So I've gone through the attorneys. I'm following the compliance. Number two is actually people would say, I can't understand everything, so I don't want to invest. Let me think about it. Let me go home. And so then let me clarify. We raise the capital. Under
Hmm.
this, you're going to fill out this form and this form. And this is the proof you invested with me. It's a promissory note. And this is where the money's invested. It's very transparent. This is not a black box. You can go to, let's say, Abi Capital Fund. You can show it online. Here are the assets we already acquired. These are assets I had outside, and now we have a management agreement with them into the fund so you can see what we already have in. Oh, okay. Now they understand. Now they can see. They gather the concept. That's part of what I do in the training is like, let us set up the website for you because it's going to help you be successful. And then
Hmm.
the other thing is people that say, oh, I'm making more money because I'm trading the stock market. Okay, and what are you doing? Oh, I'm selling covered calls. I'm selling puts. And okay, well, how long have you done it? Well, okay, I lost money the last 90 days, but I think I'm going to make a lot. Okay, well, let's start now. I in a diplomatic way, I weed out the fantasy from the reality. Let me tell you,
Right.
if trading stocks and option could make money, Warren Buffett would have done it. The big funds would have been trading every day, but they buy, they dollar cost average, they do it in stages. And if that's what you want, then good luck waiting 40 years to do the compounding effect on this, because the stock market is not going to give you 8% per year. It's going to give you 15% one year, it's going to drop 7%, it's going to recover 7, and you haven't even broken even now. Do the
Hmm.
math. And then I explained to them. So there is this, I'm doing something else. Like I remember this, I did a presentation and this gentleman came to me, he said, I buy the properties. This was in San Mateo, California. He said to me, next to San Francisco, I'm a broker and I get properties from the auction and I buy them and I fix them. I said, okay, so how many do you do? He said, one. How long have you been, has it taken you? He said, okay, 18 months, but we're going to be done before the end of the year, which was going to be 4 more months, and I'm going to sell it. So how much are you going to make on your money? He said, easy, 14% a year. I said, okay, I'm offering you 8. You telling me you have $1 million in that deal. If you give me the $1 million, I'll give you 10. And he said, yeah, but that's 10 versus 14. I said, yes, but how long is it taking of your life? And he said, I kid you not, he looks behind me, he said, okay, my wife is coming. Don't mention it. Don't mention it because she's frustrated. We haven't taken a vacation for 2 years. I need to finish this project. So I said, so for 4%, I can free you up. So that guy was hard to pitch, but about right around Christmas, he contacts me and he says, I think you're right. I need to free myself. I just did some simple calculation. I'll do more in my brokerage work with less risk, less effort, putting the money in a fund at 10%, the Class C shares, and then I don't have to really hassle with contractors and finding the properties and doing all this. So that person also is an objection,
Hmm.
you see? The
Yeah.
final objection you can get is people that say, you know what, I'd rather do the properties myself. I do small investing. If I lose the money, I can blame myself. If I make the money, I'm happy. I find ways to reduce my taxes. So they're not looking to simplify their life nor to grow. They just have a routine of some sort. They're
Hmm.
hard, but usually those are the people I follow up with. How are you doing? Would you like to look at this some more? By the way, we just acquired this property. So then sooner or later, sometimes you have to see something 2-3 times until it clicks and you say, I should buy this or I should get involved in that. And sometimes I tell people, you don't have to give me 250,000. You could come in with 25.
Hmm.
Once they get in with 25 and they get their check on February 28th or August 31st, guess what? A lot more money is coming. I've had people sell their buildings and come into funds because they say this is simpler. This is something that is controlled by the SEC. And at least
Hmm.
I know it's in my backyard or it's assets that I like.
Hmm.
And it's fixed return. They don't have to wonder, why did it take you so long to fix the building or whatever?
Hmm. When you're suggesting marketing, right? So I came to you, we're doing this. I have 3 properties. I want to scale to 30. I set up
Mm,
this fund. Right now, I am like going out there raising capital. Would you
mm.
recommend I stick to the warm channels, like people I know or people who, like friend of friends, or going to like networking events where I, know people? Or do you also recommend cold channels like, oh, just do Facebook ads, YouTube ads, like where we it's the audience is completely cold. So are there your strategy both on the warm and cold side, or you prefer just focus on the warm side?
Okay, I prefer we start always with the friends and family or the investors that know me and they did something with me before, because I challenge people, once we roll out the fund for you, go talk to 5 people, just 5. Raise money from 5 people, even if it's 25,000 each. What happens is a transformation in your mind. You now Your identity changes. I'm no longer the man that buys land and sells it, or the man that does this, or the woman who gets these properties and split them. I am a capital raiser. I raise capital. I'm a fund manager. You have relabeled, re-identified yourself to the market. And the first 5 people give you the momentum and the encouragement to then suddenly go bigger. And when you show up in a meetup or when you show up in an investors club, you say, we have this website. You can see what we're doing. We have some investors already. And here is a video with the investors when he came in to look at this. But now all of a sudden, you have something to show, and it organically starts growing, and you start getting the 250,000, the 500,000, the 100,000, the IRA money that sits there for you with years of reinvestments. And then go from the warm leads, what I call the affinity group that knows you, to a little bit larger, which is people that will hit subscribe because they want to know what else is going to happen. Look at this property now. We just got it. We're rehabbing it. And if you follow me, you're going to see what's going to happen next, because we're going to take a drone picture next month when we finish the rooftop. And the people all of a sudden are like, yeah, let me see what this person is doing. And then you go to the cold world out there. You go into an investment club. They give you 3 minutes on the stage and you stand there. And that's the part I do the training of. How do you build that it becomes a normal thing, that you have positioned yourself in a different way? You have a 30-second pitch, the elevator pitch of a minute, you have the video of 14 minutes, you have PowerPoints, you have a website, and all these distribution channels. All you need is to raise the first million after that. Once the first million is raised, it's organically. Organic is crazy.
Yeah. Do you
And by
see
the way,
like, sorry, go ahead. Go ahead.
oh, no, don't forget your thought. Tell me. I won't forget mine. Tell me.
No, I was saying, do you see like students get like, obviously this is like their new title now, fund manager. Do they get
Yes.
like too excited and then now they're all about raising funds, but they forget about the fact that they still have to deploy that capital and
Okay.
generate cash flow?
But it's true. I do see people. Like I had an investor who came in. He said, "I know so many people. I'm going to go tell them about this." So he had already some investment that he had bought an apartment building, and they carried the financing. Was doing very good cash flow. He had another one lined up, and he realized if he had more money, he would have done a bigger deal at a much better price. Like the cash flow would have been crazy. So he went and raised, and the excitement got so big because what he was already doing, it was in Atlanta. He raised 700,000 more than he had deals for. So he called my office and he said, "Okay, now I have a reverse problem. I got more money and I can't find good deals. So that money's coming in. These people are going to pay me tomorrow so much, and this is going to be 700." And that's something I didn't count on, which is when we set up so many people real estate funds, I found out that if John Doe has more money, Susie Johnson may be actually acquiring a deal want to expand it. And I can say, let me put you in touch with Susie, talk to her directly. So we set up now the real estate funds in a way that they can do joint ventures. So his 700,000, he took it and done another deal with a husband and wife that are doing developments in Temecula. I said, listen, he's going to do the work and you're going to get 20% and you're paying your investors 6, 8, and 10. So you have 10% on that 700, you're going to make 70,000 doing nothing. It's all upside gain. And they're happy and you're happy. And it may happen vice versa, like that they sell, they have more money, they can work with you. So you find that everything, it revolves around three things. Your knowledge. So the way you comprehend what you're going to do and the judgment calls become better. Number two, the actions you're going to take, which is going to be the skill level really gets to a level of professionalism where the cycle of action is shorter. So knowledge, action, and the third most important thing that people don't realize is networking. Because you only can have so much knowledge and so much intelligence and so much action you can take. You have so much energy, so many hours in the day, and so much credit. But once you get the networking and you have elevated yourself to, I'm a real estate fund manager, you can now attract the network, not just pursue it, but you can create an exchange of value. You have the deal, I have the money, let's do a joint venture. Oh, I have the deal and you have the money, I'm already a fund. Let's come into my fund and I'll do the things for you. I've gone to real estate investment clubs and pitched to raise capital. And then I go to the back and tell them, hey, come talk to me about your IRA, whatever. And people come and say, I want to sell my property. Are you interested in buying? I'll do a seller carry back. So in the same place I'm raising money, I got even better deals. So the structure itself, there is a saying, if you actually watch any of my videos, I always say the money is in the structure. Everybody has a strategy, but very few people have a structure. And when they try to raise money, if they don't have a structure for people to fit in it, every person giving them money, no, I want 50%, no, I want 15% interest, no, you're constantly having headaches trying to structure different things, and it's not following the law of the land. which is if you're going to raise money and invest it on behalf of investors, you must be filed with the SEC under certain regulations. They will protect you. You do all the disclosures, follow the rules, you're going to grow exponentially.
Right. I mean, you could technically do JV deals with pretty much every single investor, but it's like very painful to maintain and everything, right?
Yes, yes. And sooner or later, then they start fighting you because they had the money, you had the experience, but now they have money and experience. So now they don't want it that way. They want it that way. So
Right.
many partnerships end up being little fights and not completed the way it should be, you know?
Yeah. I want to talk about, like, obviously we talked about all the pros, like all the
Hmm.
good things that come with the structure. Let's talk
Yes,
about some of the bad things. Like, for example, when things go wrong. Like, say,
yes,
obviously not every investor is like a good real estate investor, right? There are
yes,
some
yes.
bad ones. Like, I'll tell you an example. I
Uh-huh.
had this guy. He's a fund manager. Like, exactly what we're describing here, raises funds for his real estate. He has like an apartment building or whatever. I mean, he's small time. And he was supposed to come to my show, and then he just didn't show up. Right.
Uh,
So stuff
uh,
like that. There are people who are just like they don't commit to the things they talk about and say.
Very good point.
So
Yes,
clearly, those are the people, they struggle with this. They might raise too much capital. They don't know how to deploy. They might get desperate and buy a property that they shouldn't have bought, right? And
yes,
clearly now they cannot provide the returns back to investors. So
yes.
how do things unfold when
Okay.
things go wrong on the investment side?
Okay, very good. So let me just describe failure in one of two ways. This is one of two things happen. It's either a mindset, and you can right away talk to somebody and predict this person is going to fail. Why? They're dreamers. They're talking too big. They're talking too much about things that they've never done, but they're talking about them like as if it's going to be tomorrow. I'm talking to somebody with 100 million. And it's like, so that person's mindset is going to make them fail. The other
Hmm.
failure is a situational event whereby you did everything right and the market collapsed. Look at San Francisco, July 2024. Market collapsed. Brokers were calling me saying, okay, what's going on? Do you have any action? Because we're listing properties, open house, nobody's coming. What happened? You could have been the best investor in the world, but in San Francisco, July 2024, until really the end of the beginning 2026, a month ago, was a very, very bad time, especially on higher end properties. So that could be the perfect mindset. You've done everything right, check the box, and you fail. So when it comes to the SEC, let's assume the worst case scenario. You raised money, you bought a bunch of properties in X locations because usually you're diversified a bit, and the war started. And interest rate went through the roof, gas went like crazy, etc., etc., etc. All the negative stuff that can happen. So you're wiped out. What happens? If you have disclosed everything truthfully to the investors, we're buying this because you have every 6 months you do the payout, you send a letter. We bought this, we sold that, we're looking at this and that. Thank you for investing. If you have any friends, family members, or anybody you know would like to invest, please refer them to us. We'd love to bring them in. And now you say, okay, market is bad. We are unable to sell. It has slowed down completely. You're disclosing everything truthfully. And now the worst has happened. You can barely sell the properties, come up with 20 cents on the dollar after you pay the debt and liquidate everything. And you disclose to the investors, here's what happened, here's the situation, here is the proof, here are the links to the Marcus Millichap and Coldwell Banker and all what's happening in this market. We're losing the money, but we're not going to file bankruptcy for the fund. We're going to do this. Believe it or not, somebody with a real estate fund or a syndication is better off and is protected when all the bad things happen because they acted truthfully to the best investment they could and communicated everything openly with full transparency. The SEC is going to say to the investors if they complain, this person told us the activity and they're filed with us. We have them right here in the Reg D, whatever. They've been with us 3 years or 2 years or whatever. The market went down. They're not in control of what happens with interest rate or government's activities of war and all that. So sorry you lost your money, but there was all the disclaimer and disclosures about risk. You lost the money in good faith. Get your 20 cents on the dollar, claim your taxes, and move on. If that person was just borrowing from people right and left and didn't follow rules or filed with the SEC, and these people complain, SEC will jump and say, you've been doing illegal activities that are not approved in the United States to raise money on behalf of others. You are now suspended from any further activities like this. You're going to have to pay a fine, and it's going to become hell for that person. A lot of people don't understand that. So you do things right. Worst case scenario happens. You did not take the money and go buy a yacht. You didn't take the money and acted neglectfully, like went to party in Spain, in Marbella by the beach. You know what I mean? You just did everything properly.
Right.
So in conclusion, the individual that's going to set up a fund should have a strategy that makes money. They should learn how to scale it. They should learn what assets are going to produce income that should be in the portfolio, such as lending, discount notes, seller carryback financing. And if they get into things that don't provide cash flow right away because they're going to buy a property and improve it, then they do the Class C shares and explain your investment is in Class C, so we're not going to pay you cash flow until this and that. And if something goes wrong, they say, we're delayed, but don't worry, we're going to do this and that. We're still accruing your money. That we have even a provision in the fund that if somebody's not able to cash out on a certain time, we can't cash them out. There is a small penalty. We pay an extra 1%. But I can tell you from all the investors I set up, maybe a couple of them were delayed to cash out somebody, but they communicated truthfully. Look, this property is delayed to sell. It's in Florida. There was a hurricane. We need a couple more months. And guess what? The investor said, hey, no problem. I understand. I saw the hurricane news. I saw what's going on. We'll wait a couple months. I mean, so we have not, I mean, I'm very selective who I choose to set up funds with. There is actually a form called the bad actor form. Like if the person has acted badly before, the SEC already will say, hey, this person is a criminal. They took money before and embezzled this and that, So
Yeah. So to summarize, as long as you're acting in good faith, you're all doing the right things, there's obviously like market risk that can,
yes,
temporarily, delay things. But if you're doing the right thing, and SEC will kind of like side with you that, you didn't have any bad intentions and you were not a
e-
bad actor.
exactly.
Hmm. I know we spend so much time on funds. I have like 50 other questions. I'm hoping we can cover few of them at least.
Whatever you like. I'm
Yeah,
focused with you. Mhm.
yeah. On the joint venture side, you mentioned QSRs. Can you
Mhm.
explain what that strategy is? I was like fascinated by it. That you
Sure.
have. So these are like smaller restaurants, quick service restaurants
Yes.
they're vacant. Tell me about that strategy.
So I take people that want to get into commercial real estate and they say, look, I want to break into commercial real estate, but they're asking for proof of funds. It's a little bit more complicated. I don't know how to get the good deals. I say, okay, let me start you with a strategy that I'll train you on. It has no downside and a huge upside. They're like, it's too good to be true. Well, let me show you. Simply, let's say you're driving and you see a single tenant property. It's a single tenant building, standalone building, and it's sitting vacant and it's for sale. And it's a two-way traffic. So you call the broker and say, how much do you want? The broker says, I'd like 675. And you say, that's too much. It's sitting vacant. I'll give you an offer for 600,000. That
Mm.
broker is going to ask you, they're not going to ask you, are you pre-qualified or pre-approved? They're going to say, do you have proof of funds? You either have the
Mm.
money for a big down payment, like 30%, 35%, or you have the cash. And you're going to say, I'm going to buy it cash. Why? Because I'm going to give you the proof of funds with millions of dollars. I have credit lines for millions and I have a lot of cash sitting always. So what happens is now you tell them, I work with a real estate fund and we're looking for this type of property. Here is my proof of fund. That deal, we can do it, but it's got to be 600,000. We'll close all cash. We want 45 days due diligence, 15 days to close. Right there, you told the broker, I'm serious. We can do this. And you followed my description. There are 16 criteria I look for a building to say, this is the building and this is how much you should offer. There is formulas for it. And it's a training I do for a whole day. Like I'm just trying to give you the summary of it.
Mm.
So we're looking for, so you know what we're looking for, give you the summary of it is heavy traffic, good neighboring tenants, decent building that will take like auto repairs, auto zone, auto pep boys and stuff. Those are very desirable. Clinics, all medical stuff is very desirable, but the most desirable is the QSRs. They're the largest growing one, the quick service restaurants. There is thousands of them, and their business model is to grow. If they don't
Mm.
grow, they don't make money. So many of them are national companies that want to come in and give you a corporate guarantee. So what happens is when you call the broker and you show them the proof of fund and you put the property under contract, now you have the right to buy the property for 45 days due diligence, 15 days to close. I give the individual, I give you 4,500 plus national tenants, the size of place they want to be in, the places they want to grow, who they like as their neighboring tenants, and who to contact. And I tell you exactly the script you tell them. Make you take a video of the place and all this, and then you call them and you say, my name is Abi. I have a property at 123 El Camino Real. It's got so much traffic. It's got those neighboring tenants. I have a little video for you. Please take a look. And if you're interested, reply back and we can get on a conference call to discuss further. And you can call as many tenants as you want every day. You have 45 days. All you want is
Mm.
one tenant to call you back. One tenant.
Mm.
You know how exciting that is when they call back, say, okay, we need to get on a call to discuss the details of this opportunity. And we have a couple questions. The Starbucks that's behind there, when was it actually open? Because on Google Earth, we did not see Starbucks, but in your video, we see Starbucks behind it. You know, that, you know, right there, they're half sold. So what happens?
Mm.
They forward the email to me and I get on a Zoom call with my joint venture partner, the student that I trained, that's starting in commercial or want to change his commercial activities to these type of properties. We get the tenant representative. They usually work in the offices of the tenants or they're exclusive brokers for the tenants. And we tell them, and we go on the call. Yes, we would like, let's say, 60,000 a year in rent. That's like very low rent. Okay, that's 5,000 a month. That's like pennies. Okay, usually it's about 8,300 and higher. But so that's 60,000 a year. You're with me?
Mm.
60,000 a year. That's the base rent. Then it's triple net. That means the tenant will have to pay the property tax, insurance, and maintenance. So we tell them from the broker information that gave it to my joint venture partner student, hey, the insurance is 6,000 a year. The taxes are, I don't know, 5,500 a year. Okay, so that's your triple net. Then the tenant will say something like, okay, we saw the video. We're going to send somebody, but how much can you give us for tenant improvement? So I give them. We'll give you 50,000 tenant improvement. No, we need, if you want 60,000 a year, can you give us 2 months free rent and 75,000? Okay, we'll give you 75,000. So what ends up happening is we work the deal with them on the phone, 10-year lease, escalation 3% per year or 15-year lease, corporate guarantee. That means this lease is guaranteed by the corporation itself. And that
Mm.
makes it a very airtight deal. Once we have that letter of intent, the joint venture partner now can go buy it if they want to buy it for themselves. I've negotiated for them, even though I know they won't assign it to me. That's part of our deal when we do the training for them. Or I just get the assignment, they assign it to me, and then
Mm.
I take the deal. And then that property that is now from 60,000 a year is going to sell at 6%. So property will be worth $1 million, but he's got it under
Mm.
contract at 600. So it's going to go up $400,000. Even if I'm giving tenant
Mm.
improvement, I tell them, don't worry, from the contract price to the actual 16 times the rent, which is 6% cap, because 60,000 a year rent, base rent, is 6% of $1 million. So the property would be worth $1 million. That's a cap rate of 6%. So we
Mm.
say, I'm going to give you $40,000 assignment fee. Now, I've had people do the deal 2 weeks after the training. I've had people do it. I've had assignment fees 200,000. They can look on YouTube. Just put Cherif Medawar success stories, and you will see. I've had
Mm.
people like this guy's like new complete. He's 21 years old, and first deal came out. It was such a high deal. It was unbelievable. And sometimes the last 3 years here, we've been getting people that you call a tenant, national tenant, and the national tenant says, we have a franchisee that will buy it from you. How much do you want?
Mm.
Well, we have it under contract. We're going to buy it anyway if there is the tenant interested. But if there is no tenant interested to lease, somebody want to buy? Okay, we have it under contract 600. They were listing it at 700. Okay, we'll sell it to you at 700. So
Mm.
so they do an assignment to the big tenant and they make 100K. Those I let them have it directly. I don't get involved. I just coordinate the
Right.
transaction.
Right.
So that type of deal is a it just requires like, where is the hard work? Where is the hard work? The hard work is in the follow-up, because I give them the proof of fund to get the deal. I give them the training to talk. I give them the script. I negotiate the LOI, but they must call the tenants and follow up the next day and keep talking to tenants and sending emails, etc. For the first, I would say the first 2 to 3 weeks, you will know right away how many we're getting and how many we're negotiating with. All we need is one.
Mm,
So I would say within 90 days, somebody finishes the training, that would really close on a deal. Some people are luckier because there's a degree of luck in anything. Some it takes like 2, 3 deals to close, but the knowledge is for life. And after they assign the first deal to me, the second deal they do by themselves, because now they have some money from the assignment. They have
mm,
experience. They still have the tenant list, and I still help them. That's why I get success stories, because I tell them, like, I have this gentleman. I told him, he said, I have family money. I'm never going to assign to you, but I like that you're doing the training. I like the success stories. I like the details of the training. So he gets the deals. We negotiate the deal together for him, and he just
mm.
gives me success stories online.
It's the finding these properties is not the hard work.
No, finding is the easiest part, because we're not looking for distressed sellers. We're not looking for unusual situation. They're literally listed by brokers in their
Mm,
backyard. I mean, I challenge you today, take a car and drive around. You're going to find single tenant buildings vacant. And
mm,
the brokers usually say, I don't want to bring a tenant. It's too much work. It's too many calls. I'd rather go get
mm,
another listing. It's going to make me more money,
mm.
because the brokers think in one way,
Right.
investors think in another way. And once you get
Yeah.
going, and by the way, if you do one deal for yourself,
Mm,
you're buying it for 600,000. So the bank is going to ask you 30% down. So you're going to have to put 180K down. They'll give you the loan. But as soon as that tenant comes in signing the lease, that property is worth $1 million. I mean,
mm,
how many deals can you do that if the tenant doesn't call you in 45 days, you cancel the deal, you get your earnest money deposit, usually only 5,000 back. You have no downside, but you have a huge upside. So if it
yeah.
doesn't work, you lost nothing other than some phone calls. But
Yeah.
when you buy a deal and you put some money in, and now you have a cash flowing property with a big tenant for 10, 15 years, you
Mm,
then come back and say, Cherif, I need to set up a fund. You set up a fund, you raise enough money to cash out your down payment, and you go do the second deal for yourself, raise money to
mm.
investors to cash. So your 200,000 works like $2 million. And if you're
Yeah.
paying the investors and making just just 1,000 per month on each property, because you have no money in it, you just have your money
Mm,
working again, and you have a fund and investors, you do 10 deals, you have in 10,000 a month, and all the
yeah.
upside is yours. If you sell each one with the 400,000 gain, that's all yours. That's like 10 properties, 400,000, that's $4 million. How do you think
Mm,
people become so wealthy in such a I became so wealthy in such a short period of time? Because if you look at my inventory at crepr.com, that's exactly how I did it. I tell people,
mm,
this is how I became worth millions, tens of millions over years. And now
mm.
properties are paid off, because it's been like a lot of years. I mean, I started that 20 years ago, 2003. So what's that? 23 years ago. So it's easier for me
Yeah.
now. But I mean, my kids, how do you think my kids went to college? I just got a credit line on this property. I told my daughter, here, and here is a new car, and you get better grades, I'll get you a better car, and you do this. And my son,
Mm,
oh, you want to do AI? You want to be in the house by yourself in the house? I'll pay this for you and make the payments until you carry yourself with the college thing online. So it gives you
yeah.
a whole new perspective on things.
Yeah. I mean, it is a really good strategy. And you have the funds to kind of like back it up with external capital if need be. So,
Mhm.
I mean, yeah, I mean, there's just so much to talk about. I know we're like out of time. I am sure you have
No
stuff coming
problem.
up. I have stuff coming up. Um, just to wrap it up, I know we started with the marketing challenge that you're dealing with. So just to close that loop, if you could just like 90 seconds summarize how you're tackling that marketing challenge for the education side of the
The
company.
way, yes, thank you. The way I'm tackling the marketing is I'm actually posting more frequently with the company we have outside the United States. It's a company in India. They do an amazing job. They're great people. I've been with them many years. So they just take clips, because I do once a month, the second Saturday, I do a call with investors. So they buy a membership to call me and ask me live. This is a private call, and there is like 50, 60 investors. Usually there are a bunch of, and the call could be an hour and a half, 2 hours, could be 4 hours. And I tell them, if you're sick of me, hang up. It's going to be on the website for you to watch the rest later. It's been very successful. And the marketing company, the Indian company, what they do is they take some clips, some questions, and post part of it. And that has been very successful because people say, oh my God, never heard this concept. This is so creative. This is so unusual. And they ask me live questions of these being made. I did this and the title company said that. How can I do it different? So I've had so many years of experience. I mean, I worked for a billionaire when I was a kid, and Harvard called him the man with two brains. When you could count billionaires on one hand, Edmond Besari. As a matter of fact, my picture with him when I was 22, 23, in front of his castle in France, Edmond Besari, you can see it on LinkedIn. So my experience is so deep that those marketing clips have helped me a lot. And the thought that I had earlier, and I said, don't forget your thought, was that one of the best ways to raise money is, believe it or not, Abi, is like what you're doing. You're educating people, you're helping them. And in life, it's kind of, you're not giving to receive, you're giving out of faith. You want the best for people, you're learning in the process of teaching and exposing people like me to your network of people. So it helps me also grow. So it's like everybody wins. You're creating a win-win-win. You learn, I expose my knowledge, they get to learn, and they get to appreciate what you're doing. And that, you set up a fund and you say at the end of each show, remember, we have a real estate fund. If you want to know what we're doing with people like Cherif or something else like this, call us and we will send you our video for the presentation. Or go to our website, you'll see our new assets. So when you use that marketing of being exposed out there with information and education, people get attracted because now they understand. No more blocks. No more like, what does that mean? Oh, now I see it. I believe it. I can go feel it and touch it. I want to invest. And that's really, really the essence of good investing and goodwill out there.
Yeah. No, I couldn't agree more. Cherif, if someone is watching this, they like what they're hearing, they want to partner with you, they want to learn from you, what's the best place for them to reach out?
The best place is the cmrei.com, which is Cherif Medawar realestateinvesting.com. They can go on, they can email my vice president, Ashley, at cmrei.com. Ashley, ASHLEE, at cmrei.com, like Charlie, Mary, Robert, Edward, international.com. So cmrei.com, easiest way. And that is, if they put Cherif Medawar with a C, Cherif Medawar, on YouTube or anywhere, they'll see plenty of videos. I have like 3,500 videos, 2,000. Some of them are training, the rest are success stories and people talking about what they've done with me or through me. And that's the idea. Thank you for the exposure and for the time, Abi. It's great interviewer, man.
Yeah, no, Cherif, that was so like the complete knowledge bomb, like so much value, so much learning. So I really appreciate the time that you spent and with us. I'm so thankful.
Thank you, sir. Much appreciated here.